Well, welcome back to The Explainer. Today, we're bypassing the hype and dropping straight down into the engine room of the blockchain world. We are looking at the foundational architecture, the actual core machinery that powers this whole massive ecosystem. It's this wild space where complex computer science crashes right into economic game theory, and getting a grip on this is absolutely crucial if you want to understand where digital assets actually get their true value.
So what actually secures a $2.96 trillion digital economy? I mean, really think about that for a second. We're not talking about thick steel vaults or, traditional banks with armed guards. We're talking about pure code. What kind of mechanical engines could possibly safeguard nearly $3 trillion in value in this 2026 institutional era?
Okay, here is our game plan for today. First, we're unpacking consensus. Next, we'll weigh the ultimate trade-offs. And then, we're going to dive into 3 real-world case studies: Cardano's governance, Bitcoin Cash's scalable payments, and Dogecoin's evolution into a cultural commodity. Let's get right into it.
Before we do anything else, we really need to anchor the stakes, right? And we do that with this massive number, $2.96 trillion. To put that into perspective, we are talking about nearly $3 trillion with a T. That is the global cryptocurrency market cap in 2026. As our sources point out, we have well and truly moved past that early super volatile speculative phase of the 2020s. We're in a mature institutional era now. Functional utility, clear regulations, and hardcore structural resilience are what drive valuation today. The underlying engines of these networks literally have to be flawless to hold up that kind of weight.
All right, Section 1, Unpacking Consensus.
Let's strip away the jargon and keep it simple. A consensus mechanism is basically just the protocol through which all these distributed network nodes reach an agreement on whether transactions are valid or not. It's the absolute bedrock of digital trust. Look, because there's no central bank, no CEO calling the shots, and no middleman verifying the ledger, the network itself has to have this bulletproof mathematical rulebook so everyone can agree on the exact same truth.
And the original, probably most famous rulebook is Proof of Work, or POW. Let's walk through how this actually operates. In POW, a transaction kicks off, and these network miners bundle them into a candidate block. Now, to permanently glue this block to the chain, these miners have to burn through massive amounts of computational energy. They're basically redlining their hardware, rapidly cycling through random numbers to crack a crazy hard cryptographic puzzle. It is an intentional, brute force, physical competition. First one to solve it, broadcast the block, the network checks the math, it gets added, and boom, the miner gets a reward.
But as you'll see here, there's a dominant alternative, proof of stake, or POS. Follow the flow on this one. That whole energy-heavy mining process, totally gone. Instead of competing with racks of buzzing computers, participants, called validators, lock up their own actual tokens as collateral. It's their stake in the game. The network then pseudo-randomly picks a validator based on how much they've staked to propose the next block. Validate honestly and you earn a reward. But, and here's the kicker, if they act maliciously or try to sneak in fake transactions, the network hits them with what's called a slashing penalty, literally destroying a chunk of their locked money. Ouch.
So seeing them side by side really highlights the stark mechanical difference. On the one side, proof of work protects the system by making it prohibitively expensive to attack in terms of raw hardware and electricity. And on the other, proof of stake makes an attack prohibitively expensive in terms of direct, immediate financial loss. It's brute force physics versus highly efficient economics.
Which brings us to Section 2, the ultimate trade-offs.
Let's systematically run through how these two heavyweights stack up across the 7 key metrics from our source study. Proof of Work has this undeniably incredible decade-plus track record of ironclad security. But, it pays a steep price for that. Super high energy use, heavy environmental impact, slower processing speeds, and fees that can spike wildly when the network gets congested. Proof of Stake basically flips the script. It's laser-focused on efficiency. It maintains very strong security, but with virtually no energy use, tiny environmental impact, lightning-fast speeds, and super stable, scalable transaction fees.
But hey, neither system is some perfect utopia, right? They both face very real, unique centralization threats in this 2026 landscape. Proof of Work is super vulnerable to mining pool dominance, basically a few giant warehouse-sized server farms controlling most of the network's computing power. Proof of Stake, conversely, struggles with wealth concentration and custodial staking, because having power means holding tokens. A few ultra-wealthy individuals or massive corporate exchange platforms can easily hoard the voting power. So you're kind of picking your poison.
All right, let's look at how this plays out in the real world. Section 3, Cardano, focusing on governance and staking.
Remember that centralization risk we just talked about? Well, check out this number, 22. This is Cardano's Nakamoto coefficient as of May 2026. If you're not familiar, the Nakamoto coefficient is just a metric that measures how many separate entities would have to secretly team up to successfully attack the network. While a lot of legacy networks hover around a dangerously low 2 or 3, Cardano is rocking a really impressive decentralization score of 22, and that's powered by over 2,000 independent validators running on a heavily peer-reviewed architecture.
And Cardano is really putting this highly secure foundation to work for some serious enterprise tasks. Thanks to the Plutus V11 smart contract upgrades, the whole network is fully self-governed now in its Volterra era. Token holders use an on-chain coordination body to directly manage a massive multi-billion-dollar treasury. They're proposing, voting on, and executing their own technical roadmaps. It's essentially a self-sustaining corporate structure entirely built out of code.
Now let's switch gears. Section 4. Bitcoin Cash and scalable payments.
So, as we pointed out earlier, traditional proof-of-work networks have a really hard time with slow speeds and high fees, mostly because they strictly limit the size of their data blocks. Well, Bitcoin Cash tackles this head-on by using a massive 32-megabyte baseline block size. But the really brilliant part is their adaptive algorithm. Think of it like a highway that magically adds extra lanes the exact second rush hour hits. The block size dynamically adapts to real-time network demand, meaning that no matter how crazy things get, transactions still clear almost instantly, and the fees stay firmly under a single penny.
But listen, Bitcoin Cash is not just about simple peer-to-peer payments anymore. They are radically expanding what their base layer can do. By natively integrating custom tokens and NFTs, the network can actually run fully on-chain decentralized exchanges right on the base layer. No clunky Layer 2 workarounds needed. Thanks to the May 2026 upgrades adding loops and functions, Bitcoin Cash is morphing into a fully programmable DeFi commodity. And the crazy part? It's all still secured directly by old-school, traditional SHA-256 miners.
Which leads us to Section 5, Dogecoin, the cultural commodity. Yeah, you heard that right. Dogecoin has completely evolved from an internet joke into a legit Wall Street-recognized digital asset. But the most intensely debated thing about it is its tokenomics. As our source points out, the unlimited supply with 5 billion new coins entering circulation annually creates persistent inflationary pressure. Now, if you're a traditional investor looking for digital gold, an unlimited inflating supply sounds like an absolute nightmare, right? But proponents actually argue this is Dogecoin's superpower. They say this inflation makes the coin perfect for everyday spending and high-velocity use cases, like tipping on the X-Money platform, rather than just hoarding it away in a digital vault.
And when you look at Dogecoin's 2026 evolution, the narrative gets really fascinating. First, it secures itself by merge mining with Litecoin, tapping into that massive shared proof-of-work security. But from there, developers are proposing zero-knowledge proofs for advanced Layer 2 apps. And they're even exploring a hybrid community staking model. Think about that. A meme coin actively working to layer cutting-edge smart contracts and POS staking right on top of its traditional mining base.
Which is a perfect segue into this fantastic summary point from our academic source. Hybrid consensus models present a potential path forward by integrating the robustness of POW with the adaptability of POS. And honestly, looking at these case studies, the future really doesn't look like a zero-sum game. It's not just a cage match of proof of work versus proof of stake anymore. Instead, we're seeing this fascinating blending of the two, where networks are cherry-picking the raw computational muscle of POW and combining it with the lightning-fast economic agility of POS to scale for the globe.
So I'm going to leave you with this thought. As institutional money pours in, and as these networks literally become the core plumbing of global finance, which consensus model do you think will power the next $1 trillion of digital value? Will it be the rigid, time-tested physics of proof of work, the swift, highly efficient economics of proof of stake, or some crazy hybrid that we are only just beginning to wrap our heads around? It is a question you absolutely need to be asking about every single digital asset you follow. Thanks for dropping into the engine room with me today on The Explainer. Catch you next time.
Thank you for watching this video. Please subscribe this channel.